stop. Before you hand your kid a single dollar, write that check, or transfer a dime to your grandchildren, you need to watch this video first. Because right now, millions of Americans are unknowingly walking straight into a tax trap that the IRS has been quietly waiting on. And the worst part? Most people don't find out until the damage is already done. Welcome back to Senior Pulse US, the channel where we cut through the noise and give you the real financial truth that actually matters for your retirement years. If you're new here, hit that subscribe button right now, because what we're about to cover could literally save your family thousands of dollars. Today we're talking about the gift tax. And before you tune out thinking, "I'm not rich, this doesn't apply to me," that is exactly what the IRS wants you to believe. Because the gift tax trap doesn't just catch millionaires. It catches everyday retirees, grandparents, and hardworking Americans who simply want to help their families. People just like you. So let's get into it, and let's get it right. Here's the thing most people get completely backwards. When someone says gift tax, they immediately assume the person giving the money has to pay a tax on it. Wrong. The IRS does not tax you for being generous, at least not right away. But here's where it gets dangerous. There's a very specific line in the sand, and the moment you cross it without knowing what you're doing, you've just triggered a reporting requirement that can follow you and your estate for the rest of your life. In 2024, the annual gift tax exclusion is $18,000 per person per year. That means you can give up to $18,000 to any individual, your son, your daughter, your neighbor if you want, without filing a single piece of paperwork. But the second you go $1 over that limit to any one person, the IRS says you now owe them a Form 709. That's a gift tax return, and most Americans have never even heard of it. Now here's where 90% of people make their critical mistake. They think that filing that form means writing a check to the government right then and there. It does not most of the time. What it actually does is start eating away at your lifetime exemption. As of 2024, that lifetime federal exemption is $13.61 million per individual. So for most people, no out-of-pocket tax gets paid immediately. But, and this is a massive but, that exemption is set to drop dramatically after 2025 when the Tax Cuts and Jobs Act sunsets. We're talking about potentially getting cut nearly in half, down to around $7 million. That means the gifts you're making today could have serious implications on what your estate owes tomorrow. Let's talk about the real traps, the ones that blindside people when they think they're doing everything right. Trap number 1. Giving too much to one child. Say you want to help your daughter buy a house. You write her a check for $50,000. You don't think twice about it because you love her and it's your money, but you just exceeded the $18,000 annual exclusion by $32,000. That $32,000 now chips away at your lifetime exemption and must be reported on a gift tax return. If you forget to file, penalties. If you never knew about it, the IRS doesn't care. Trap number 2. Paying bills directly, but doing it wrong. Here's a little-known escape hatch that most people miss entirely. The IRS has something called the tuition and medical exclusion. If you pay your grandchild's college tuition directly to the university or pay someone's medical bills directly to the hospital, that payment does not count toward your $18,000 annual exclusion at all. Zero, unlimited, gone from the equation. But, and this is critical, you must pay the institution directly. If you give the money to your grandchild and they pay the school, you just lost that exclusion entirely. The difference between doing it right and doing it wrong is one step. One phone call to the bursar's office instead of writing a check to your grandkid. Trap number 3. Married couples who don't use gift splitting. If you and your spouse are both living, you can actually combine your exclusions and give up to $36,000 per year to any one person without triggering the reporting requirement. This is called gift splitting, and it requires filing a return to elect it. But when used correctly, it can allow you to move significantly more wealth to your family completely tax-free. Most couples don't know this exists. Trap number 4. Giving appreciated assets. Let's say, instead of cash, you decide to give your son stock that's gone up significantly in value since you bought it. You think you're being smart. You think you're avoiding the hassle of selling it. But here's what happens. Your son takes that stock with your original cost basis, not today's fair market value. When he eventually sells it, he could owe capital gains tax on decades of growth. Sometimes giving cash and letting them buy the asset fresh is actually the smarter move. Every situation is different, and this is exactly why getting advice specific to your situation matters. Trap number 5. Medicaid look-back. This one is brutal, and it catches seniors the hardest. If you start giving significant gifts to family members and then need to apply for Medicaid to help cover nursing home costs, the government looks back 5 years, at every financial gift you made. And if they find transfers that look like you were offloading assets to qualify for benefits, they can disqualify you from coverage for a period of time, right when you need help the most. This isn't a technicality. This is people losing access to care because they gifted their home, their savings, or large sums of money to children without understanding the Medicaid rules. So, what should you actually do? Here's the framework that makes sense for most retirees. First, use your annual exclusion every single year. $18,000 per person doesn't roll over. If you don't use it, you lose it. Start early, give consistently, and let compound generosity do its work over time. Second, if you're helping with education or medical expenses, always pay the institution directly. Always. This is free money as far as the IRS is concerned, and too many people leave it on the table. Third, if you're married, talk to a tax advisor about gift splitting. It's a simple election that can double your tax-free giving capacity every year. Fourth, before making any large transfer, we're talking anything over $18,000, have a conversation with an estate planning attorney or a CPA who understands gift tax law. A 1-hour consultation could save your family more than you'd ever imagine. And fifth, if long-term care is even a remote possibility in your future, which for most of us it is, do not make large gifts without first understanding how they interact with Medicaid eligibility. This one conversation could be the most important one you ever have. Look, the tax code was not written to make your life easier. It was written by people who assumed you'd hire someone to navigate it for you. But here at Senior Pulse US, we believe you deserve to understand the rules of the game you're playing. Because knowledge is the single most powerful financial tool you have, and nobody can take that from you. The gift tax trap is real. It catches real people. But now you know what to look for, what to avoid, and how to give generously without giving the government more than it's owed. If this video helped you, share it with someone you love, a friend, a sibling, a neighbor who's thinking about helping their kids or grandkids financially. You might just save them from a very expensive mistake. Drop your questions in the comments below. We read every single one, and we'll do our best to cover the topics that matter most to you. Hit the like button if this gave you value, and make sure you're subscribed to Senior Pulse US so you never miss the information that actually moves the needle for your retirement. Until next time, stay informed, stay protected, and take care of yourself and the people you love. We'll see you in the next one.